Welcome to the Allan Small Financial Show. Thank you for taking the time out of your busy day to spend it with us. We have a great show for you today. Markets have been quite exciting over the past few weeks, but at times quite confusing for individual investors. I've been receiving a lot of emails and calls about how individual investors believe the markets are in tough. Should you be investing your money? I had one investor ask me, they have money sitting on the sidelines. Should they put that money to work in the markets? Because they've been hearing a lot of negativity out there. And my response has been, well, even though there has been a lot of negativity, the major indices are all higher for the year at this point in time. So I think a lot of confusion out there for investors, social media in general, speaking negatively about what's going on in the economy and the markets. Yet the stock market seems to think there are a lot of positives out there, maybe looking 6, 12, 18 months down the road for better times ahead. So we're going to talk a lot about some of these topics, some of the ideas that individual investors have communicated with me over the past few weeks. And I think all of us will learn a lot. So let's move on with the show and take a look at our topics for this week. So we're going to speak about markets and why I believe they're actually behaving in a bipolar way. Certain things I believe would cause the market to go down, and the market actually rallies that day, and vice versa. So the market's hard to predict, a bit of bipolar there. As always, we're going to have the This Week component where I talk about, or when I talk about, what I believe is important for individual investors to consider when you make your investment decisions over the next few weeks. Canadian bank earnings, we just had them at the end of May. Disappointing, yes. Expected, yes. So we'll delve into those. Consumers ignoring the economic warnings. We're seeing consumers still continue to spend their hard-earned money. Why is that? What money are they spending? And why haven't they been spooked? Why do they continue to spend money and seemingly not care about the economic conditions? Tracking the jobs market. We're going to get jobs data out of the US come this Friday, and the jobs data for Canada the following Friday, I believe June 9th. We know the Federal Reserve and Bank of Canada watch this data very closely. Unfortunately for all of us, they actually like to see the jobs data weaken a little bit. We've seen a lot of strong employment data, and the Fed has made no bones about the fact that they want to see a bit of a lull, or at least see jobs pull back a little bit. They're at all-time lows in the US. Unemployment is at all-time lows in and around 3.4%. I think they would like to see that number start to creep up north of 4%, maybe even 4.5%. So we'll talk about tracking the jobs market. Understanding the major North American stock exchanges. This is, I think, a very, very important one, because again, I get a lot of individual investors calling me, emailing me, saying, the TSX isn't working really well right now. It's only up a few percent for the year. The Dow Jones, which is also one of the major indices of North America, US index, only 30 stocks make up the Dow Jones, yet it is the index that is quoted most when you look at a lot of the newscasts or the investment shows or investment channels like Business News or CNBC in the US, etc. Yet it's only made up of 30 stocks. Well, the Dow isn't doing too well this year either, and that's throwing off a lot of investors because there are many areas that are doing well. So I'm going to talk a bit about what makes up a lot of these major North American indices and why you should be focused on perhaps other ones other than the Dow and the TSX. And lastly, I'll get to some of your questions. Hopefully we have time to answer a few questions that some of you may have. If I don't get to them on this show, please enter them into the chat boxes or send me the questions through social media during the course of the next few weeks, and I'll try and answer them next week's show, or sorry, in 2 weeks' show, when we have on a special guest, Jonathan Chevreau, which we'll touch on at the end of this show. So without further ado, let's move on with the show. So markets are bipolar at the moment. And I guess what we mean by that is very hard to predict. If we get strong economic data, for example, that we received last week, In the US, personal consumption and expenditures, we saw a number that clearly shows that inflation is not fading. In fact, inflation might be a little bit hotter for the month of April than anticipated, perhaps even a little warmer for the month of May as well. So when we get data like that, 4, 5, 6 months ago, the market would have gone down because the market would have anticipated that the Fed would use this data as a reason to raise interest rates again. Today, or last week, I should say, when we received strong data, the market actually rallied. It actually rallied. On a morning where I thought the market might go down, it rallied in the face of strong data. So that tells me that the market right now is considering or looking at this idea of a recession coming more so than inflation. I believe the market thinks that inflation is on the downward swing and that the issue of inflation, even though it's still a problem for the central banks, it's not the number one problem any longer. The idea of a possible mild recession, or even for some, maybe a bit more of a deeper recession, is more on the minds of investors than the inflation battle. And so when we see strong data, once upon a time, it would cause the market to go down. Today, strong data actually causes the market to rally, because that tells us that no, a recession is not around the corner, that a hard landing, as we've been calling it for a while now, is not around the corner, that the market is very resilient. And the fact that we have so many people working, such a low unemployment rate, is definitely helping. And that's probably the number one indicator, or the number one, I guess, economic indicator that we all watch to see the health of the economy. So markets being bipolar, well, maybe that's not such a bad thing right now. Maybe good news is actually good news, no longer good news being bad news, which was the case for, I would say, 12 or 13 months of the last 12 or 13 months. Economic data that was good was looked at as bad, and today good data is being looked at as good. So I think going forward, when we get strong data, I think the market will rally. Now, I think the market is telling us that we are going to see better numbers ahead. Market looks 6 to 12 months in advance, or ahead, I should say. And what it's seeing right now is an economy that, even though we may see a recession, it will be mild, and the market should bounce back or move out of that mild recession very quickly. And so any indications of strong economic data would be looked upon by the market as favorable. So this is the part of the show where I talk about what I believe is important for individual investors to consider before you make your investment decisions. And as always, my 3 topics for this show: central banks in a quandary. Why is it so difficult for central banks right now? The Bank of Canada, US Federal Reserve, why is it so difficult for them to set policy, to either raise rates or not raise rates? We'll touch on that, and we'll also speak about why that's important for individual investors to consider. Market breadth, what does that mean? Well, many people have been complaining over the last little while that the breadth of the markets, basically how well the market is doing, is dependent on just a handful of companies. A handful of companies' share prices are moving this market. If you were to remove those top 5 to 10 stocks out of the index would actually be flat to slightly negative. Is this a good thing? Is this something, again, individual investors need to consider? And our third point, consider being a contrarian once again. We talk about being contrarian all the time, and I still maintain that being a contrarian investor is the best way to improve your portfolio and grow wealth over time. So let's get to the first point that I'd like to touch on, which is central banks in a quandary. And interesting here, we have, I guess, the most recent, cycle of interest rate hikes over the past year. We have a chart, again, as we show it many times, and we show quite often, that central bank or the Federal Reserve has raised rates a number of times. I guess if you count over the last year and a bit, they've raised 10 times or 5%. And many people believe that it's a 50-50 chance or a flip of a coin whether they raise rates another 25 basis points come June. I think it's actually lower than that. For a little while there, while the data was showing softness in the economy, softness on inflation, I think the chances were somewhere around, well, less than 25%. Today, some are saying 50-50. I think it's more maybe 35% chance they will raise rates. But why is the Federal Reserve and Bank of Canada in a bit of a quandary? And why is this important? Well, I think the banks would love to continue to raise interest rates, but they're finding it difficult because of what's happening when they do raise rates. If you were to look here in Canada, you look at mortgage rates today, obviously at a high point that we haven't seen in quite some time. Right now, when a person pays their mortgage every month, that payment is making up 20% approximately of the income that household is taking. One of the highest levels we've seen in a while. So we are seeing that the average person here in Canada is and has taken on more debt. Our visas are a little bit higher than they once were. We're seeing banks taking on or setting aside more money for bad debts. And so the Bank of Canada is a little concerned that if they continue to raise rates, that people will find it even more and more difficult to get by, to go out and to purchase items and to do all the things that they would like to do. And we have a couple of charts showing the debt levels in Canada and how much they've moved higher. The first one here, borrowing costs, you can see the numbers basically show household debt versus the country's GDP. And I think what's important to notice here, in 2010 in Canada, 95%. Now we're well above 100%, second highest to Australia. Another chart we have as well is mortgage payments. And I think the one thing to note from this chart here is that about 1/3 of mortgages have had their payments increase. And this will rise to nearly all mortgages over the next 3 years. And so that's a powerful thing. And when individuals are paying more for their mortgage interest payments, where they're paying more interest on their lines of credit, they obviously have less money to go out and spend in the economy, buy big ticket items, go out and travel, etc. And so the net effect is a slowing economy. And so again, this is why central banks are in a quandary. They don't want to raise too quickly, because if they do, it will affect other things. And if you look at the US, you don't have to look any further than some of the banking issues that they've had, right? The bank failures, obviously raising interest rates as fast as they have, that affects the banks. Net interest margin starts to shrink. So the margin between what the banks pay on as interest and what they charge as interest, that starts to shrink, because now they have to pay out more for savings accounts, more interest on GICs, etc., or fixed income products, depending on what they are. So overall, we're seeing the central banks have some issue and may not be as quick to raise interest rates going forward. And I think it's important for individual investors to consider this, because this may be a bit of a good thing, a bit of a green light for investors. Because if the Fed stops raising rates, or at least pauses, we know the Bank of Canada has paused, and if the Bank of Canada doesn't continue to raise rates, in my opinion, this will be a good thing for individual investors. The second point that I wanted to make as one for individual investors to consider before you make your investment decisions is market breadth. And it's a term that unfortunately a lot of people don't know, but it just refers to how widespread this market rally, as we're seeing this year, and we are seeing a rally, is. And a couple of interesting charts here. One is on the banking index. I talk often about how well the technology space is doing and how much the technology sector is leading the market. Yet when we look at, I guess, a chart of the bank ETF, which we have here, we can pull up, you'll see how badly the banks have done. This is a bank ETF in the US. Banks have performed quite poorly. Pharmaceuticals have not done well. The retail space hasn't done well. Yet what has done well has been technology. We have a chart of the QQQ, which is a pretty good chart. Invesco QQQ basically invests in the top 100 tech stocks. And you can see how well this chart is, or how well this sector has done. So once again, if you were to take the top 10 names, big cap companies, which happen to be mostly technology, and you were to remove them, in the US, you probably see the S&P close to flatline, or maybe even slightly negative. But because these tech stocks have done so well over the first, let's call it 5 months of the year, this has carried the stock market higher. And lastly, in this area, this point that I wanted to make, we have a couple of stocks in particular that I've spoken about many times, one of them being NVIDIA. Shares of NVIDIA have rallied tremendously. This is a share price of a few days back, so not exact share price today. NVIDIA has actually gone over $400, and it's just been a fantastic stock to own since last fall. Another stock here is Microsoft. You can see how well Microsoft has done and how much it's also carried the index forward. Not only the NASDAQ, but also the S&P 500. Keep in mind, technology makes up something in the vicinity of 40% of the S&P 500. So when tech is going well, so is the S&P. So when you go to make your investment decisions over the next few weeks, I think you want to consider owning one or two of these big cap tech names, because I think you need to own them for growth. And it's not something that I think you want to trade. These are names that you want to buy and own. Maybe trim some of the profits over time as they move higher. But I think you always want to be in them because they make up such a large component of the growth of the S&P 500 and the overall market. So let's get to the last point, or the third point I wanted to discuss with respect to what you should consider before you make your investment decisions. And this is being a contrarian. And really, we have one chart here, and I think it's a great chart. And that's a chart on Meta, or formerly known as Facebook. And it is probably the best contrarian chart I could show you. And again, being a contrarian means you're buying when those are fearful, and you're selling when those are buying. You know, NVIDIA, for example, is a name I've actually been selling a little bit of as it has moved higher, because I think that's the prudent thing to do. That is risk management. You don't want to let all your eggs ride in the basket. What happens if something were to pull back? But Meta, and we can show the chart again, but Meta is a name that has gone up significantly since it reached its lows back, I guess, last fall, somewhere around $90 a share. Stock today is well over $250 a share. So being a contrarian investor, buying those names when others are fearful of buying, that is the way, in my opinion, to get ahead, to grow your wealth and your portfolio. It takes an iron stomach to do it, but if you can do it, it makes a lot of sense. And today, as I said, with market breadth being so narrow, there are a lot of ideas out there that are trading at low points, even with the market in general moving higher, that I think you can take a look at a lot of names to look for these names before you make your investment decisions. Canadian bank earnings. You know, we saw the Canadian banks report earnings at the end of May last week. It was interesting. A lot of the banks actually reported on the same day. So normally earnings are spread out over, you know, a bunch of days. Most of the earnings came out in 2 days. We were expecting weak earnings, and we got weak earnings. So were they disappointing? Well, yes, but that disappointment was expected. And funny story, CIBC, strangely enough, smallest of the top 5 banks, actually reported the best numbers. They beat expectations. One of the only bank, or the only bank, to beat expectations. And then the day after CIBC reported, an analyst came out and downgraded the stock, if you can believe it. So saying that stock price probably wouldn't move much higher. In fact, could move even lower. So here you have the one bright light out of all the major banks, and it was downgraded shortly after. And there's a chart of CIBC. It's kind of trending a bit to the downside, but probably a little more sideways. We have charts on all the banks here. TD Bank, as the next chart, you can see how much TD Bank has fallen off. As well, it's come back a little bit and then fallen off recently again. Bank of Nova Scotia, next bank, which pays over a 6% dividend yield. TD Bank, almost a 5% dividend yield. CIBC pays about 6% dividend yield. So these banks are quite powerful in that if you're looking for growth and income, I think these are great investment ideas, even with a slowing economy in Canada. And so why did we expect a slowdown in their earnings? Well, we're anticipating a continuous slowdown of the Canadian economy. We're expecting a continual slowdown of the US economy based on higher interest rates, as we've discussed, and higher inflation. So if the economy is slowing down, how can the bloodline of any economy, which are your banks, do well? So we're seeing a slowdown in lending. We're seeing the banks not willing to lend as much as they once were. They're having to keep their money inside or with them rather than lending it out as much. They are setting aside more money for loan loss reserves, which tells us that the banks foresee a slowdown in the economy. Not as many people borrowing to grow their business. We're seeing trading activities at the banks slightly decline, although BMO had some good capital markets numbers, or at least not bad. Some of the other banks didn't fare as well. So overall, banks are slowing down, and that is being reflected in their share price. They continue to raise dividends, however. All the major banks raised dividends except for TD Bank, which decided to buy back their own stock, which has a positive effect on their share price if you think that TD is in the market buying back their own shares. So banks continue to raise dividends. So obviously they're sitting on a lot of cash and they're able to do that. TD Bank is buying back their own stock. TD Bank in particular has a lot of money because their most recent acquisition of First Horizon, a regional bank in the US, was stopped or did not go through. So they're sitting on a lot of cash. And many people, including myself, are waiting to see what TD will do with all that cash that they have sitting there. Perhaps they'll make another acquisition. So overall, Canadian bank stocks not doing so well this past quarter. I would anticipate another flat quarter to come. And then hopefully, as we get into the second half of this year, these stocks will start to pick up again. But once again, be a contrarian. Buy when those are selling. I think these are great opportunities for individual investors. So the consumer seems to be ignoring some of the weak economic data or the weakness that, for example, the banks are anticipating and many individual investors are anticipating. They continue to spend money. And it's interesting because, well, let's take a look at the first chart that we have here, which clearly shows that what I was going to say is interesting is that Canada has the highest household debt level to GDP of all the G7 nations. You see all the G7 nations listed there, and Canada has the highest debt to GDP out of all the nations. And I remember, I guess, a while back talking about Canada having basically spending about $1.60, and I'm not sure what that number is today, possibly the same or maybe even higher for every dollar that people make. So well in excess of what they're making. And we thought, analysts, investment advisors like myself, we all thought that we would see spending start to slow. But the most recent data has shown us that that's not the case. And I believe that one of the main reason why we're not seeing a slowdown in spending is that everybody who wants a job or anybody that wants a job can find one. There are more job openings for people than people looking for jobs, I should say. So when you have a lot of job openings, what you get is anyone who's looking for a job can find one. And those that are looking for a higher salary or higher pay are moving or changing jobs to find that higher pay, which is also lending itself or one of the reasons why we're seeing wage inflation both in Canada and the US. And wage inflation can be quite sticky. So we're seeing a lot more debt here in our country. We are seeing the average person continue to spend money, however, because they have a job, because they maybe had an increase in pay, perhaps because they still have some money left over from back in the pandemic days where they received money from the government for their business. So a lot of reasons why the consumer is still spending. But make no mistake about it, we're seeing credit card levels start to rise. Visa levels or payments are starting to rise. And that is another reason why a lot of the financial institutions have increased loan loss provisions, set aside more money for bad debt, for debts that individuals cannot make payment on. So overall, are investors being silly? I'm not so sure. I guess it just depends on the investor or the consumer. Is the consumer being silly with how they're spending their money? I'm not so sure they're being silly either. I guess it all comes down to, do they have a job? Is that job paying them well? What are their expenses, other expenses? What's their mortgage payments like? What's their line of credit like if they have one? So overall, the average retailer or person will continue to spend, in my opinion, as long as they have money coming in. And so we'll definitely keep track of what's happening in that regard. But overall, this continues to power the economy ahead and at least keep us from falling into a mild recession. So we always like, as I said earlier in the show, to track the jobs market and jobs data. We're going to get jobs data out of the US June 2nd, this upcoming Friday. Jobs data in Canada will come out on June the 9th, the following Friday. And we have some really good charts here to show jobs data or job creation in Canada. You can clearly see here how it has fared, been slightly rising the last few months. And these are in thousands. So you can look back in January, 150,000 jobs created. An unbelievable number, a number that we totally weren't expecting. And then dropped down to 22,000, 35, and now 41 in the month of April. And we will get May, as I said, June the 9th. In the US, we're seeing a jobs data coming out this Friday. We have the chart on jobs in the US. And you'll clearly see that jobs have actually been coming down the last few months. Again, January numbers were great, but they've been gradually coming down. And a number, it looks like in January, well in excess of 400,000. And now we're down to about 236,000. So we like to track the jobs market data because that's what the central banks track. As I said earlier in the show, if we start to see a weakness in jobs, we start to see less jobs available, less job openings, JOLTS. That's the number we get out of the US quite often, which tracks job openings. We have less jobs available and job openings. That will mean less movement. People won't be able to change jobs for higher pay. Now, I know if you're thinking, well, that's a good thing for all of us, and it is, but from the central bank standpoint, unfortunately, that can cause inflation to stay or remain stubbornly high. So we always want to track the jobs market. We want to make sure or see how the jobs market is faring. Ideally, for the Fed and Bank of Canada, they would like to see a higher unemployment rate. I know myself and many of you watching would not like to see that, but I know the central banks would, because in their minds, that would help slow down the economy, slow the demand down for products and services, which causes inflation. And so that would hopefully allow them to pause or stop raising interest rates at this point in time, if they could see a slowdown in demand, and obviously stemming from a slowdown in job creation. So let's look at what happens this Friday with jobs data out of the US. It definitely will set the tone for the markets, both in the US and in Canada. So our last topic before we get to your questions, I wanted to touch on, as I said off the top of the show, the major indices. And we have a chart on all the major indices here. And so let's start with the NASDAQ. And actually, before I get into that, let's discuss why it's important to understand the makeup of each index. So the NASDAQ, which we'll show a chart of now, that is made up of predominantly tech stocks. The NASDAQ 100 would be your largest tech stocks. But, there are also pharmaceuticals in there and other names as well. But for the most part, this is your tech index. And you can see here how dominant the NASDAQ has been since the fall of 2022 and how dominant it has been in 2023. The NASDAQ is up somewhere in the vicinity of 23, 24% this year. So when investors call me and say things are going so badly, they're obviously not considering the NASDAQ. NASDAQ tends not to be one of the name or the index that they show on TV or they talk about most, though that index tends to be more the TSX or the Dow that you see most of, or even the S&P 500. So let's go now to the next chart we have, which is the S&P 500. And the S&P 500 is your broadest based index made up of 500 stocks, largest index really in North America. However, maybe it's not as broad-based as we think, because as we know, 40% of this index are tech names. If you count information technology, then this is even a larger amount of the index. So you can see here with the NASDAQ up 23, 24%, S&P 500 up somewhere around 9%, 9, 10% for the year. Obviously, tech stocks have definitely carried, as we discussed earlier in the show, the market breadth. Tech stocks have carried this index higher. So if you want to track how markets are doing, how basically your portfolio is doing, what do you want to compare it to? I think you compare it to the S&P 500. It is the most broad-based index and the one that I compare, and most money managers compare portfolios to. The next, chart that we have is your S&P TSX, so your Toronto Stock Exchange. And you can see here about just under 20,000, give or take, at the time when we took a picture of this chart. It's obviously changed since then. And TSX up about 3% year to date. And again, what is the TSX made of? Well, it's made up of bank stocks, which is its largest holding, oil, which is its second largest holding, and third, materials, gold in particular. And those three sectors make up 70 to 80% of the index. And all the other stocks make up just 20%. Your CN Rails, your CP Rails, your Loblaws, your Open Text, your, anything else that is not a bank, an oil, or a mining company like gold companies, that gets fit into that last 20% or so. So it's no wonder that this index has not moved up as much. It doesn't have much tech in it. We own Open Text, is a software company here in Canada. Shopify, a name that many of you may know, especially if you have an online presence for your business. But other than those two main names, I'm hard pressed to find many more larger tech names. There are a bunch of smaller tech names, but nothing on too large. So the TSX up about 3% for the year so far. Lastly, but not least, is our Dow Jones, which is flat. Dow Jones Industrial Average, 30 stocks make up the Dow. There is some tech there. There is some bank there. There's a mix of a few different sectors in the Dow Jones. And unfortunately, the Dow Jones number is broadcasted probably the most. And it probably has the least bearing on anyone's portfolio because it's only 30 stocks. So maybe someone has one or two names out of these 30 stocks, but not much more. So try not to focus too much on the Dow, even though that is the number or that is the index that is probably broadcasted the most, along with the TSX. So before you get nervous or get excited, depending on what's going on with the markets, with the indices in general, understand what it makes up these indices and where your stocks may fall under. Which index does your stock or do your stocks fall under? And I think if you're looking at the TSX, well, maybe you should be looking more broad-based at the S&P 500. If you're looking at the Dow, well, maybe you should be looking more broad-based at the S&P 500. And if you own a lot of tech names, you definitely should be looking at the NASDAQ. So now's the part of the show where I get to talk or answer many of the questions that I've received over the past couple of weeks and during the show today. And we have time, I think, to touch on a couple of questions. First one, can you please talk about your investment philosophy? And Actually, I think I got this question earlier in the year, or maybe even last year. I know I've addressed it before, but I'd like to address it again. My philosophy now has changed a little bit from back maybe 15 years ago. I was always a value investor, try to find those rock bottom prices and wouldn't buy into something unless it was rock bottom. Well, I've changed a little bit over the years because those rock bottom prices are very, very difficult to find and not as many names in that basket. So I've changed to more GARP or GARP, growth at a reasonable price. So I'm looking for names that are trading at a reasonable price versus ones that are rock bottom price. So I like those names that are trading at a discount, but you also want to look at what the price is versus their earnings versus a lot of other economic data when it comes to the companies. Cash flow is another one I like to look at. You want to look at growth, price to earnings to growth. We call that the PEG ratio. So I think if you're a GARP or growth at a reasonable price investor, you want to take a look at a lot of different ideas and not necessarily focus on just value. Yes, growth at a reasonable price is looking at value, but not maybe deep value. You're just wanting to find those names that are trading cheaply. Let's touch on one more question here. What are bonds and are they safer than stocks? So bonds are something that we don't touch on a lot. Maybe on the next show, I'll get into bonds a little more. But think of bonds as an IOU. Bonds is a debt. So it's like if I were to loan money to the Canada, for example, our country, I would be buying a government bond. And when I buy a government bond at the federal level, I'm loaning money to Canada at the federal level. I'm buying a government bond. However, you can buy corporate bonds. And what does that mean? Well, if you buy a bond from TD Bank, you're buying, giving TD Bank, let's say $5,000. And in return, they agree to pay you back your $5,000, let's say 1, 2, or 3, or whatever amount of time, whatever amount of years later. So if it's a 5-year bond, they'll pay you back the money you lent them 5 years later. And in the meantime, for them holding your money or using your money for what they need it for, they pay you interest. Again, similar to a GIC. We are probably all familiar with GICs. You go to a bank, give the bank some money, they give you an interest rate back, say 4% today, maybe close to 4.5%. And so you give them $10,000 and it's a 1-year GIC or a 1-year bond. It works the same way. In a year's time, you get your $10,000 back. Plus, if it's 4.5%, $450 worth of interest. So owning certain bonds is great. They are less risky than stocks because at maturity, provided the company or the government that you're loaning money to is there to pay you back, and hopefully government of Canada will be there to pay you back. Hopefully TD Bank, for example, will be there to pay you back. And we give, or not me, but there are ratings agencies that give ratings to different bonds from different institutions. AAA rated is the highest rated, and that's what the government of Canada is. And there's AA bonds, which is the next level down, single A bonds, triple B, double B, et cetera, et cetera. So obviously the A-rated bonds are your investment grade bonds and the ones that carry the lowest amount of risk. So yes, these bonds, if the institutions are there to pay you back, if these businesses are there to pay you back, when those bonds mature, then you get your money plus the interest. So on average, yes, bonds, especially investment grade bonds, can be a lot less risky than stocks. However, if you loan money to the variety store on the corner from where you live, then those can be risky like stocks as well. Perhaps that variety store won't be there in a couple of years or in a year's time to pay you back your money. So definitely when you look at bonds, you want to look at the rating of those bonds, and that will tell you the risk level, whether they're investment grade or low risk, or whether they're higher risk if the rating is B or C or even worse. So with that, I want to thank everyone for watching the show today, tuning in today. We have a great show in 2 weeks. We have a guest coming on Wednesday, June 14th at 12 noon. We're going to be joined by Jonathan Chevreau, author, founder of Financial Independence Hub, and a former Financial Post finance reporter for 19 years. Jonathan and I are going to talk markets, what he thinks is going on with the markets. Maybe we'll talk a bit about market breadth and the tech space and artificial intelligence. So please tune in a couple of weeks, 12 noon Wednesday, June 14th. Until then, Happy investing.